and welcome to episode 21 of Great Quarter Guys, where finance meets the freight industry. And I'm Kevin Hill, and as always, I'm here with
Mr. Andrew Cox. Glad to be back, Kevin. I missed last week because I was in a potential quarantine situation, but it turned out that
the
guy I was with that does not have the coronavirus.
Yeah, so basically it's one of those new facts of life, right? We always have to be careful about everything.
Yeah, I think you made a good point earlier about how I think by the end of this, every one of us will have known at least someone, if not everyone we know gets this. It will at least know someone that has contracted this.
We definitely will. Yeah, I think that is a given. It's just a matter of the cycle, and I think we all know it's an uphill battle right now, and the economy is certainly showing that it's uphill battle right now. And, the markets have been a little wild, a little bit wild this month. In March, I think we were down 37 or almost 40% month to date, just in March until today. And as we're filming, we have TVs all around up here in the upstairs studio. And it looks like the Dow Jones is up about 7.35%.
Yeah, I think the best way to
I need glasses,
just kind of wrap your head around it is just what was it, 7 weeks ago? We were 500 points in the Dow away from 30,000.
We were, yes.
And as of yesterday, we were under 20,000. So that gives you just a gross idea of how bad that it got so quickly.
I know. And the volatility the last couple of days has been kind of hinged on the bailout package. Or not really a bailout. It's more of a stimulus package. I hate to call it a bailout package.
Yeah, it'll likely include some sort of bailout for some industries, but
for some
it
industries
is a fiscal stimulus,
and individuals, and it's more of a stimulus bill, certainly than what you saw back in the TARP funds and then really a bailout for the banks. So that is really an important distinction on that.
I agree. And, we can jump right into, I actually did a deep dive this weekend.
Yeah, let's talk about your deep dive. We're going to talk about your deep dive, and then we're going to have Peter Rentschler from Carrier Direct on, and we're going to talk about FedEx and XPO. Yep. Both of them are final mile e-commerce kind of players, kind of going in the same direction in different ways. And basically strategic alternatives kind of off the shelf on that. And then we'll talk a little bit about credit risk, because the economy right now, whether you're a freight brokerage or a trucking company or even a shipper, right, you have to be aware of counterparty risk, because there's some large bills that might not get paid, right, Zach? And so we're going to talk about like that. But your deep dive, on Wednesday you told me that I want to do this deep dive. And I said, you know what? I don't know if we can go that far. I don't know. And by Friday, it was like, oh, yeah, certainly go do it. And by Monday, by the time we put it on FreightWaves.com, the number you were going off wasn't even the high number.
I know. It's, I was telling you earlier that these last 2 weeks have been the longest and craziest 2 weeks of my life, for sure.
Yes.
The middle of last week, I was thinking...
crammed 3 yeyears in the last 2 weeks.
At least. I think a decade or so. But I was thinking about
You're
what
get gray hair
Treasury. I already have it. Yeah. I was thinking about what Treasury Secretary Mnuchin said. I think it was last Tuesday. He had a meeting with Republican senators in which he was just trying to convince them of the need for fiscal stimulus that is in need right now. And what he said is that he thought, by his estimates, that we would reach 20% unemployment if significant fiscal action wasn't taken. And he didn't say that he never said that he was going to release his actual model for which he got to that number. So I said, you know what? Let's go ahead and model what that would look like. Could we even reach 20% based on the estimated declines in GDP and the estimated declines in revenue by industry? And I just kind of took a look at the industries that are going to be hit the hardest, that are already being hit. What are the layoffs going to look like, and what does that mean for our economy in 2 to 3 months?
And what did you? And we went off a baseline of 20%. So how do we even get to 20% unemployment? Because let's go back 2 weeks, maybe a month. I would have no idea how we could ever even assume to get to 20% unemployment.
Yeah, I mean, right now, for the last few quarters, we've been looking at record low unemployment, 3.5%.
3.5%.
This economy has been chugging along. We seemingly every job report that came out, it was just more and more jobs. Everybody was, something would come out. We're expecting 165,000 jobs, and 275 come out. This pop-off number. So this economy has been extremely hot. So yeah, I agree with you. So basically, what were the assumptions you used to go from 3.5, which is basically beyond full employment, 3.5
to build a case how it could get to 20% unemployment.
Yeah, I thought it was a big
very
jump.
short time period too. I mean, we're not talking
8
years,
weeks. Yeah.
weeks.
Yeah, I'm talking 8 weeks in this time period that it could happen. And I went off of Goldman Sachs, basically estimates by industry who was at most risk. You know, they broke it down into 4 different risk categories, which was near cancellation and total risk. And there were 2 industries in here. There was sports and entertainment. And included in that entertainment is things like museums, things like anything group oriented that you would go to for entertainment, movie theaters, anything of that nature. And then you have major hit, large hit, and limited hit. The major hit was a 65% reduction in revenue through April. So here you're looking at public transportation and gambling. And then the large hit companies, they're expecting to hit 50% hit to revenue through April. And now we're looking at hotels, food, domestic services, and I think even that number could be lower, because think about the restaurants here in Chattanooga, for example, just to be anecdotal, every one of them is closed down, except for those that are doing a little bit of takeout delivery, but even those are kind of few and far between right now.
Those are few and far between, and basically the revenue and basically the margins on the takeout that they have to do is much lower than having dine-in customers ordering alcohol, which is very high margin, or even soft drinks. Yep. Really high margin food, and having that atmosphere. Yeah, and I think you're seeing that in every city now. Is certainly bars and restaurants, any kind of concerts, sporting events, is all closed down.
Correct. And you've heard the saying in a lot of restaurants, especially those that aren't fine dining, that you pretty much just serve food so that you can sell more alcohol and sell more drinks, because that's where your money's at. You're looking at 200, 300, 4% margins on those drinks, while you're looking at 5 and 10 on food. So
think about Italian places where you get a bottle of wine. Yeah. I mean, that's a lot. You buy a $40 bottle of wine.
That costs them $6.
I know.
Right. Yeah. And they're losing out on all that. So, I do think that 50% maybe even lowballing, but we went off that number. And then the limited hit is pretty much everything else. We're looking at a 20% revenue hit through April for things like all the goods, excluding food, nonprofit services, education services, pretty much everything service-related, not included with food.
Okay.
So using those numbers, I basically just put some baseline layoff estimates using that decline in revenue, because I assume that most of these companies are going to be trying to bring down costs in line, or even at a quicker rate than they are bringing down that revenue's declining. So using that thesis, I put 3 different exposure level groups together using the NAICS industry codes that the BLS puts together. So we have an extreme exposure level, a high exposure level, and a low exposure. The extreme, I'm estimating 75% layoffs in the short term. And let me go ahead and state that this is without fiscal stimulus. My scenario with fiscal stimulus, most of the layoff estimates are cut in half. I do believe that this fiscal stimulus is certainly needed, and it will help curtail some of this drag on the economy and the uptick in unemployment. But it's not gonna. I think
the numbers have grown since you started this exercise, right?
Yes.
The amount it depends on what amount you go by. The House amount, the Senate amount, negotiated amount. Who knows? But it could be almost double what you had. You had 1.2 trillion.
Right. It could end up being upwards of 2. We don't know yet. There hasn't been a bill passed. I'm not here to speculate what they will end up passing, because nobody even knows at this point. But either way, in those 3 exposure groups, in my extreme level, the 75% layoff, I'm looking at air transportation, so airlines and oil and gas. And the oil and gas industry, I put them in that extreme exposure group, not only because of the effects of COVID, but because of this oil price war that the Saudis and the Russians are in. The commodity prices are so low that they're just not going to be able to keep people on the staff, nor are they going to be drilling any new wells with commodity prices so low. So they're in the extreme. The high group is where the vast majority of the exposure is, and these are massive industries. That's the big thing about the way that COVID and these lockdowns are affecting us, is that the top 2, retail and food services together, accumulate almost 30 million people in the U.S. And most of these people are completely out of work right now. They've either been furloughed or outright laid off. So this is why I think you're really going to see an uptick in unemployment rate. We talked about that Goldman Sachs estimate of weekly jobless claims, and they're not the only ones that are expecting upwards of 2 million come Thursday.
I think that's almost the consensus now. So basically, Goldman was the first one that I saw out, and that was sometime Friday afternoon. You'd already written the paper, basically, by the time that hit I saw it on Bloomberg, I think. And 2.3 million, which basically, so week over week, jobless claims, which comes out every Thursday, and it's basically unemployment claims. So basically, week over week to last week, it jumped 30% to 280,000. Yeah, 270, 280.
Jobs. Yeah.
This week is the consensus is that it's going to be up 9 times, 900%.
Yeah, it's going to be unlike anything we've ever seen in not only modern history, but any history since the Great Depression. You know, we've that one chart that was on Bloomberg, it kind of gave a look at 30 or 40 years of weekly jobless claims, where you see this band between 250 and 500,000 jobless claims. I think weekly jobless claims only got up to like 600,000 or so during the Great Recession.
At the peak of the Great Recession, 600,000. So, I mean, on Thursday, it could be it could be over 3 times what the peak was in the Great Recession. And if you get a chance, you certainly go to FreightWaves.com. And what was the title?
The title is "Could We Reach 20% Unemployment in 2020?"
Yeah, look at the article, and certainly, I don't think the graph's in there, but we'll throw the graph somewhere.
Social media or something.
Yeah, we'll release it on social media because it was the scariest graph I think I've ever seen.
Yeah,
I mean, it was like literally it went down. And it was just a straight line up.
Just perpendicular, yeah.
Yeah, off the chart of the map.
Yeah,
I mean, basically, yeah. So,
and so basically, you know, when we look at these industries that are going to be affected, at 75% for the extreme, 50% for the high, and 10% for the low. This 10% was manufacturing, transportation, excluding air. So this is when we're seeing these brokers and drivers being laid off right now. That's in the 10%, the low exposure, and then warehousing and mining. You know, we're actually seeing the opposite in warehousing right now for at least some of the big guys, for Walmart and Amazon. We've seen them together. They're expected to hire 250,000 people. But you got to think about those other goods that aren't being bought, the big ticket items of the warehouse. You know, things.
Anything that's discretionary, necessary is the demand has hit a brick wall, and I don't know how we get out of that. But you know, the 2 companies that we're going to look at are heavily into e-commerce, into that. Certainly, I guess neither of them work with Amazon for 2 different reasons. Right. So they don't comprise. Amazon's not their customer, but they're heavily into e-commerce and the Walmarts and the other big box retailers, which when you are under shut-ins or self-quarantining, e-commerce becomes a big deal.
Yeah, it becomes the only option. I'm going to talk to Zach and Anthony later on Freightonomics, either today or tomorrow, about the impact of sentiment this is going to have. And you know, we can talk about economic recovery. We can talk about how we're going to get people back to work, whether it's in 2 weeks, 2 months, or a year from now. The big problem for me is that people's sentiment for one, going to public gatherings, and 2, buying big ticket items. There's so many things that people are going to be so reluctant to do moving forward that I don't think this economic recovery is going to be this V shape that people are expecting.
No, you know, I mean, and I grew up. My grandparents were the kids who grew up in the Great Depression, who went out and fought and sacrificed World War II, and it made up them for the rest of their lives, right? They were, for better or worse, a lot of times, they were impacted and, I won't say scarred, but, you know, they carried that attitude with them for the rest of their lives. And I think that there's a very good chance that...
Do you think the coronavirus will have some sort of the type of impact generationally that like a world war had?
It very well could. It very well could. We don't know what's going to happen from here. But certainly if we don't get it in check, it really, I mean, it could.
I think there's a point to jump on there that you just said, that we don't know what's coming, and I think that's something that a lot of people aren't admitting right now. They're putting these economic estimates out, or the health estimates we'll leave out, but we're looking at economic estimates, whether it be unemployment or hit to GDP. There's so much uncertainty that we're seeing these wide-ranging estimates that people don't really know. So I think every estimate you read needs to be taken with a big grain of salt.
Oh yeah, definitely. This is a true black swan event. I mean, it's a true black swan event. So basically, you cannot predict what's going to happen in 3 months, 6 months, 9 months, 3 days, based on historical norms or averages or anything. It's a brand new world. You know, basically, they used to joke during the Great Recession, you know, this is a 1 in 10,000 year event, and it keeps on happening every 15 minutes, you know, with Bayesian statistics. So basically, there's no predicting what will happen. You know, we were talking, you said it earlier, so much has happened in the last 2 weeks. I mean, we've put a decade in the last 2 weeks, so it's just going to be hard to predict. But yeah,
certainly. So you want to let's put a bow on this.
Put a bow on it, and I'll dial Rentschler.
Yeah, go ahead and call Peter. So when it came down to it, when I finished up my modeling, I didn't quite get to that 20% unemployment. That's why I do believe there's a little bit of the fear that came from Mnuchin when he was telling these Republican senators. I do think that his number was probably near 20, but I think he probably gave it around 20 to stroke a little bit of fear into Republican senators. But then again, you saw Goldman Sachs and J.P. Morgan and a lot of investment banks. And Fed Chair Bullard, I think of Oklahoma City or
St.
Dallas,
Louis, maybe.
I don't know.
I don't know.
One of the central federal bank chairs. He stated that he's expecting 30% unemployment.
Yeah, 30% unemployment.
My 15 doesn't seem all that unachievable.
It doesn't. And I don't know if we have a long short on unemployment in April.
We got a little something.
Then I'll wait.
We'll hold off on.
I'll wait on that.
Yes. But while we're waiting, I call. Peter, I'll go ahead and lead in a little bit about FedEx. You know, FedEx had announced earnings last week. They missed slightly on revenue and earnings, but overall, the market sentiment for FedEx has turned in the last couple weeks. We've seen their stock got absolutely crushed for the last 3 or 4 months, but in the last 2 weeks or so, they're back up 20%. They had fallen all the way, and they've come back down. Do we have Peter on?
I'm not sure. Peter, are you there?
I'm not sure we're hearing Peter. Here we go. Kevin and I always talk about live podcasting. We've got to walk through the kinks here.
It's always an adventure.
But let's. I'll jump into a little bit of why kind of the market has begun treating FedEx the way that they had treated them for 15 years. FedEx was always kind of the blue chip stock of the industry, of transportation. Everybody looked at them as the industry leader. And people are starting to kind of think that mojo might be back. And some of those reasons are they've really gone all in on e-commerce, where they had kind of been avoiding e-commerce for some part of their supply chains. They would go as far as dropping it off at the local post office so that USPS could finish up. Do we got him?
I don't know. Peter, are you there?
Well, right. So they would go as far as to drop it at the local post office so the USPS could, drop that last mile package off, which is typically a less profitable sector, a less profitable part of the move. But now, with the help of a new marketing executive that they had brought on, that he's been there for a long time, but they've kind of moved him as to be the successor to Fred Smith, and the current CEO. He has kind of completely shifted focus and strategy to full-on e-commerce, and they've done this all the while they've completely cut ties with Amazon. So it's a focus on e-commerce. They're making the Shopify or the little guy bet rather than partnering with Amazon, which owns 40% of the e-commerce demand.
Yeah, they're exactly right, and they're building more ties into Walmart and big box, but definitely Shopify is a really good target to go after. I think basically they have. I think it's projected to be about 70 or 80 billion in e-commerce sales, or at least their subscribers have 70 or 80 billion in e-commerce sales for 2019. We just finished up that year, so it'd be really good to partner. Basically, since Shopify is expanding into the distribution part of it, to have really small businesses that were hurting right now because of the coronavirus, be able to offer those same delivery type of options as you get with Amazon.
And there's a couple other points of strategy that they're making changes. One, which happened in the last couple of months, is that they finally started running on Sundays. They opened up all 7 days of operations, which is a help for e-commerce play because that people can order things 24/7. There's constantly ordering, so they really needed that 7th day. So they've added that, and they've also kind of integrated something that they've gone away from for a long time. They've integrated some FedEx, of the ground and express duties. They've kind of packaged that into the final mile for the ground. They'll put some of the express goods on there, which is something investors have been asking for a long time.
It has. It's something that Fred Smith, who's the founder of FedEx, has resisted historically. So he's been resisting this, and finally Raj came in, or he's been there for 30 years, so he didn't just come in, but basically he became COO, and he's the man, as they say, behind the plan. He wrote the plan to integrate FedEx Ground and FedEx Express, and to deliver that type of one solution that you were just describing.
Right, and this is one of the reasons that the stock has bounced off the bottom for the last couple of weeks. Investors absolutely cheered this move. They're expecting that it can save FedEx hundreds of millions of dollars in the next couple of years as they continue to integrate this.
And I think on the flip side to that too, that they can capture a lot of market share. so they can save costs and create and grab a lot of market share out there. In e-commerce, that's still rapidly growing, and there's no thought that it still won't grow even through this rough patch right now.
Yeah, I mean, this is just this is steroids to the e-commerce batter right now. I mean, it's going to continue to keep growing them. What do you think? What do you think of this FedEx e-commerce strategy? Do you think this is the right move? Do you think they should have cut? Do you think the cutting ties with Amazon was the right move? Do you think they're capable of building this on their own?
Yeah. So basically, it's a low profit business, Amazon. So you don't lose that much except for maybe network effects, keeping your capacity utilization. They've drawn back some of their capacity too because of this, which I guess right now is a plus. Right, is to shed some capacity before, but before something a crisis like this happens. He seemed pretty confident on Face the Nation. Fred Smith did. I believe he was on there Sunday. He was pretty confident that they wouldn't accept any of the $8 billion that's available for air cargo. There's $50 billion for the airlines, passenger airlines. I think $8 billion for air cargo. So he's pretty confident that he would not be. They wouldn't have to touch it. So that's good. And basically on the e-commerce side, business to business is where they've always kind of historically been, but business to business isn't really growing, right? It's very slow, mature growth rate. E-commerce is where all the high growth is. So to grow, FedEx needs to get into e-commerce, and this is exactly what they should do.
Well, good. Yeah, I agree. I mean, we all know that e-commerce is growing on a multiple of GDP. People are ordering more and more goods online, and not only the traditional goods like we had done at One Things, whether it be bigger items, they're now getting into the smallest of items. People are ordering toothpaste from Amazon, and that being it alone. So, I think they have to get into e-commerce if they're expected to continue being a blue chip powerhouse in this industry.
All right, very good. Before we go to XPO, I don't think we have the Bluetooth set up yet. Peter, are you there? Can you?
Mine.
Oh.
Hello.
Yikes! Yeah, you're here. You're here. You're coming in loud and clear here in the studio. How are you doing today, Peter? You there, Peter? We had him for a second.
All right. Well, thanks for sticking with us, guys. We are working through some kinks. This is my first time at least doing this outside of the booth, so we're rolling with the punches here.
Yeah, you're good.
Hey, you there, Peter?
Hello?
Yeah.
So if you can hear me, I can't hear you.
You can't hear us at all? Peter, can you hear us now? Well,
all right.
Let's just roll with the punches.
Let's roll
here.
with the jump right into XPO. We'd spoken a lot over the past couple months about XPO because of the incredible story that it had been as a roll-up play in so many different little sublets of the industry because that's what Brad Jacobs does. He's a roll-up guy.
Started in about 2011, 2012 with a $150 million investment, and as you said, he started rolling things up.
In 10 years, he made it, multi-billion-dollar,
17 acquisitions,
worldwide entity.
Yeah, 17 acquisitions. At one point this year, I think it was $9 billion market cap. It might have.
Yeah, it's been half since.
Over the last 12 months, it's just been a wild ride for XPO.
Yeah, it really has. I mean, and on top of that, they thought they weren't getting the multiple that they deserved. They have so many different business units that, and we and Wall Street and everyone likes a simple story. They like a company that does one thing and they do it really well and they don't really have to worry about, other things in their business. But that's not the deal with XPO. They do a lot of things really well, and because of that, because that it's a little bit of a more difficult story to digest. Investors haven't given them the multiple that they probably deserve.
Yeah, and Brad Jacobs, who's the founder and CEO of XPO, has often complained, and he complained, or he stated his opinion on this last earnings call. I think in mid-January was their last earnings report that they came out with Q4 earnings, and basically the gist of it was that they're getting valued. They're not getting the multiple that they want. They're getting the multiple like a conglomerate and not pure play with 4 or 5 really good businesses.
Sure.
So basically, that was his strategic alternative to drive shareholder value. If the market wasn't going to give them the multiple that they deserve, they would sell off these different businesses, which truck brokerage being one, logistics and warehousing. The LTL business they were going to keep. So you had domestic truckload brokerage, domestic warehousing logistics. You had European logistics, and that was the game plan as of like mid-January, and we wrote a passport research thing. We all jumped in together.
We gamed off what the XPO spinoff would look like.
Yeah.
4 out of the 5 business units they were looking to sell off. But as of last week, or as of this week, Brad Jacobs has walked that back, and they've said that they're no longer going to go after those strategic divestments.
Yeah. So basically, about a year ago, it was right before our FreightWaves conference back in May. Right, they were trading around 40-ish. $40 a share. The stock had taken a really big hit because of a short seller report that came out.
Yeah,
pretty
poorly founded.
Poorly founded short seller report that knocked the stock down. So you had a depressed stock value at that point. It ran up all summer, all fall.
Yep.
You get to January. I think it was around January 15th. Brad Jacobs came out on Kramer. Jim Cramer, and said that we're going to do we're going to pursue strategic alternatives, and part of that will be spinning off one or everything we have. We're going to keep the LTL. We're not getting the multiple that we deserve. It's shot up to just shy of $100.
Correct.
Right, and this was just a month ago. Actually, it was February 20th or 21st, and right now, after the month we've had, it's in the low 40s again.
Correct.
And we had it valued at 125 as a sum of the parts.
And that was our baseline model there. Brad Jacobs has always been a man of rebuying stock as well. Back when XPO was in the 40s, 50s, and 60s, he, as the company, repurchased 25% of their stock when it was in the 60s. Now that it's in the 40s, and they've now gone away from this strategic alternative idea that they're going to sell off, do you think that XPO begins a massive buyback plan?
I think so. And part of this was last week or the week before they bought a majority share of a Kuehne + Nagel, a logistics company in the UK, which was kind of strange if you're trying to spin off the logistics business. And right now you're not going to get the deal done. There's no way to value. And so basically we wanted to have Peter on this week, last week, and JT as well to talk about how do you value your trucking business. But you can't value anything right now. The valuations.
We'll save that idea for one, when we're all back in the office, and two, everything is semi back to normal. It may be September
where you can
by the
value
time we have
right?
that. But
so you can't do a deal right now, so there's no reason to even pursue a strategic alternative. But with that said, they bought back 25% of their shares last year, 2019. They were aggressively buying shares last year. They bought back 25% of the share. So I think they're going to be aggressive again this year. Maybe not quite as aggressive as 2019, but at $40, I'd be aggressive if I was Brad Jacobs. I'd be a aggressive share-back buyer.
Yeah, Brad Jacobs has proven that he's got 2 main levers that he can use to rake up that EPS and try to bring the valuation up. As one is rolling up and buying smaller brokerages, whether it be or LTLs or anything to try to get some more earnings and income onto the balance sheet, or it's with stock buybacks. So I think we're going to see both of those this year. I think they've still got cash on hand. They've got $3 or $4 billion dollars in cash. So I do think we're going to see stock buybacks, maybe not at the rate of last year. And I also think I don't even think that's the last deal we see at least try to get attempted for XPO throughout this year. I think they might try to take advantage of this wild valuation ride that we're on right now and try to scoop up some players.
I think they will too, and basically we'll see how everything shakes out. The trucking market, movement of goods, especially essentials, doing really well right now. Sonar, our outbound tender volume index shows a 30% year-over-year gain. Our capacity indicator, which is rejections, is, I think this morning was 18%.
Correct. Yeah, it's higher than any point in 2019.
In 2019,
so higher
yeah.
than, and it's nearing. The first half of 2018 was a much tighter capacity scenario than the back half. But if you kind of average out the last 6 months of our outbound tender rejection index for 2018, we're about that level now.
Yeah.
So if you're in the industry, try to think back about what it was in the second half of 2018. That's the type of capacity constraint we have right now.
Yeah, and basically, I don't know where it goes from here. As we said, it's hard to forecast anything.
So much uncertainty.
Or use any kind of historical data to go forward, but it could sustain this for a few weeks, and it could come back down to a level that isn't horrific.
Yeah, we can
I don't know.
pivot away a little bit from the specific companies to talk about just the overall freight dynamic right now. You and I were talking about how all of this demand has shifted away from grocery stores and retail, or not away from grocery stores, away from restaurants and tourism or retailers. But somehow these grocery stores and I guess everything that's still open has been able to pick up demand, whether it be at the shelf or the restocking at DCs. And like you said, in our outbound tender volume index, we're seeing 30% year-over-year gains in volume. So when is this going to stop? Are we going to see this volume fall off a cliff anytime soon, or do you think we'll see a gradual bring back to normal levels?
I don't know on the second part of that question, or I guess there wasn't a first part of the question, but what you were, I know, right? Yeah. But your point that you made, are we going to see a shift away is a story that we're working on right now. Noe Mahoney, one of our journalists, is working on that to see if your traditional companies that deliver to restaurants are shifting their focus away because there's, of course, less goods going into to the restaurants. So are they going to shift away and work the traditional lanes of maybe DC to retailer?
Right, and that's actually a beautiful thing about owning a trucking business in this environment. One of the few beautiful things ever about owning a trucking company, because it's a difficult market. But it's an empty box, and if you need to fill it with different goods that you're not typically moving, as long as you have a contact with a shipper or a good broker that can connect you to freight, it's an empty box, and you can move things. You can move whatever it is.
And part of the capacity too, there's FMCSA has basically a waiver right now for authority for hire for private fleets. So trying to get a little bit more capacity into the system to reroute those or to add extra capacity, certainly for the essentials. And we'll see essentials moving through the country, I think, for at least 3 months.
And that's a good point because, Ravi Shankar, the Morgan Stanley analyst, he mentioned that he believes that 60% of truckload demand is tied to consumer staples, to those essentials, which that number seems a little bit high to me. But in either way, I think his thesis is correct in that trucking may actually be okay through all this, is because they're moving the goods that have to be moved. They're the frontline workers here.
Yeah, if you check the 60%, and it does sound high to me, but if you do take that, then if you're running above trend on the 60%, then the auto plant closures, the discretionary products that are usually moved right now, if that falls, 20-30%. From there, you kind of even out to where it's not a horrible market for trucking. It's not going to be great, but it's not going to be horrible.
Yeah, so. I mean, it not much can get worse than the back half or the summer of 2019 where we saw volumes not a high level, and we saw just so much capacity flooded the market.
So even with it might not be horrible, even with a Goldman estimate of negative 25% GDP
in Q2.
Right?
And again, this is back to the uncertainty in that GDP number. Like 25%. This is the same investment bank that was expecting a negative 50% GDP Q1 for China and a plus 65% Q2. So I mean, these numbers are just so wide ranging that, again, take everything with a grain of salt. It will be bad. Who knows how bad? And anybody that's trying to really put a hard number on it's just guessing at this point.
It really is, because who came out with a 50%? I think it was the St. Louis Fed. So the Fed governors are coming out, or the Fed
chairman,
the
regional chairs.
The regional from the regional branches, right, are coming out and kind of throwing out even wilder numbers than the investment banks right now. 30% unemployment. It's like everyone's trying to top each other.
It's an arms race to see who can get the biggest headline at this point.
Exactly right. It's a maddening world right now.
Well, do you want to jump into the DHL supply chain pricing power index while we're kind of talking about the market a little bit? It's topical. This is again, this is a weekly index that we put together. We synthesize a lot of our data here on Sonar, and also some economic data that we get from the government, and
kind of what we've been talking about, right?
Yeah, it's exactly
OTVI,
that's why it kind of leads in.
Fed information, Goldman Sachs, Morgan Stanley. Just whatever we can get our hands on.
Yeah, and we do this. It's a range between 1 to 100. 0 to 100. 0 being all the power to the shippers, 100 being all the power to the carriers. And we've jumped up. What is it now? 40 points or so in the last 2 or 3 weeks. We've seen this just massive panic buying and panic restocking thing that's really shifted a lot of the power to the carriers.
Yeah. So basically, we were at 25 2 weeks ago, right? Or
I think we were. Yep.
Or two turns ago. Two turns ago,
yep.
Right? So basically 2 weeks. We're at 25, and more than doubled to 55 now. So basically that balance of power is at 50. 55 puts it over in the carrier's realm. I think it would probably go higher this week.
I agree.
From every indication that we see in Sonar, it will go higher this week. It might go higher for the next couple weeks. But what's our 3-month number? Because we do a 3-month forecast.
Yeah, I'm glad you brought up the 3-month number. The 3-month number currently, so we'd be looking at, what is it, mid-June or mid-July on the 3-month number, and it's back at 40, so almost a balanced market, but some of the power to the shippers. But I'm glad you brought the 3-month outlook up, because 3 months ago, what would it be, back at the beginning of January, we put our 3-month outlook out for the third week of March, and we expected it to be at 50 or at 55. For much different reasons, obviously.
I know, right?
We were expecting a normal freight market at 10,000 or 10.5 on the
capacity
OTVI.
Capacity leaving, right?
Yes.
And we pegged it at 55.
Yeah. So for much different reasons, capacity has left, capacity has tightened, and volumes have surged to levels. Honestly, I never thought I'd see. I don't think we'll ever see numbers this high again in the OTVI.
Because OTVI is an index, so it doesn't move that much. It's not like this highly volatile graph that you'll see. OTRI, which is a rejection index, is pretty volatile, but the index for volumes isn't very volatile. You don't really see too much volatility because it's an index and it's based on 10,000.
Yeah, for example, just look at
over the last 2 weeks. Yeah,
Christmas, where literally everything shuts down, no drivers on the road, and you only see that index fall typically 40% or so, from 10,000 to around 6,000. So think about the difference there. We dropped 4,000 when nothing's on at Christmas Day, the worst.
Christmas Day, nobody's moving,
on
right?
the road, right? 40% drop. Now we've seen a 30% jump from our normal 10,000 level in the last 2 weeks. It's absolutely bonkers.
We're basically closing. Have we surpassed 13,000?
I think we will tomorrow.
Okay. Yeah. So it's an amazing
we're 16% over the 2018 peak, and 2018 was a record year for freight.
Yeah. So we're well above it.
It's just crazy.
Yeah. So 3 months. Do we peg that?
Yeah, it's at 40. Yeah. So we're expecting now. I'm hoping. Well, this is all going to be dependent on so many different moving factors. Whether it be how long the quarantines last. How long is it before we have a mass-produced cure, not even cure, but a remedy? If we get a vaccine by that point, which we likely won't in 3 months, we're looking at the end of fall or winter before that hits. So we could still be in this very similar environment 3 months from now, where we have most people still working from home, most restaurants and retail businesses shut down. We may not have anything different in 3 months. We don't know.
We might not. We might not.
There's so much uncertainty.
I don't know how much of this is like restocking from hoarding and panic buying, and how much the essentials will come down to a more a level that's in line with consumption, like typical everyday consumption.
Correct.
Because usually people don't have to have 500 square feet of toilet paper, right?
Yeah. Anthony and I talked about that a couple weeks ago. He was like, how long can this jump in volumes last? And I was like, there's no way it can, because the fundamentals of the American consumer haven't changed. Whether or not we get a stimulus, we don't have any more money now than we did 3 weeks ago. Why should we be buying 30% more? Why are 30% more goods moving? So this buying that we've forced up the demand, we've cleared off the shelves, we've cleared off the DCs, and now we're restocking the DCs and the shelves.
Yeah.
That I think we're going to see volumes fall off a cliff.
How many cans of baked beans can you eat in a day?
I can't eat more than one.
I know. Cans, Clorox wipes, hand sanitizer. It's about the only thing that I think will get consumed a lot more. Going forward.
I like that. Speaking of that, I like that Costco's not allowing any returns of hand sanitizer or toilet paper, anything that all these, bad consumers went out and hoarded for themselves. They're not taking any refunds on those, which is good.
Yeah.
They shouldn't.
I saw someone with a whole shopping cart full of eggs. There's a picture,
Full of
right?
eggs?
I didn't see an actual store. Like cartons of dozens of eggs.
Eggs, yeah.
Like 40 of them. I mean,
Wow. Yeah, I mean they don't go bad very quickly. So I mean you can use those. A lot of people do.
How
I
many
mean I know
times-
people that eat 12 eggs a day. So that one,
True.
toilet paper. Nobody's going to use 40 rolls of toilet paper
True.
in a week. So
True.
that one, eggs I can almost see. But every time I've gone to Walmart, and I've gone like 4 times over the last week, no eggs.
I know.
That's why I was talking to Anthony about it the other day, that this panic buying that begun with toilet paper and hand sanitizer and wipes has now gone to rice, pasta, beans, eggs, dairy. I mean,
Yeah.
I go and everything's wiped out. It's not just toilet paper. So, I mean,
Yeah.
this buying is absolutely, it's bonkers.
And I do want to apologize to George for missing toilet paper, but
What is
it
it?
had to be.
Okay.
yeah.
And I apologize to everyone that we weren't able to get Peter on. I apologize to Peter for not being on with us. We'll get him on next week. We'll talk that out. You want to wrap it up with our long shorts?
Let's wrap it up.
Okay. Well, okay. I have a little bit of a twist to this first long short.
And
This-
I haven't even looked at them, so
Well,
I'm
that's good.
really
You don't have
interested to hearing these.
This is more of which are you longer rather than being long short. So
Okay.
it's and which are you longer, an actual enforced national lockdown, or an encouragement to go back to work? And we'll put the time period out for 2 weeks. In the next 2 weeks, do you think we're more likely to have a national lockdown enforced, or we're going to have our administration telling us to go back to work?
That's a tough one. That really is.
You want me to start?
No, I'll go ahead. I think we're going to see a prolonged shutdown rather than the administration. And then the administration might say it, I don't know. But I think we're going to see that just because, we've been looking at this ever since early January, whenever it popped up in Asia and Wuhan, because basically it affected freight flows. And it has affected freight flows for the entirety of 2020. Not necessarily pandemic or epidemic since in the early days, but we've been tracking this for 3 months now. So I think just by the very nature of it, we're going to see a prolonged shutdown.
Yeah, I wanted to jump on our first. We did our first coronavirus update came on. We talked about it January 27th. So that would have been, we have been on this for nearly 3 months now, and we've been talking about it for 2 weeks before that. So yes, I agree with you. I will play devil's advocate here because of the kind of the words and the tweets that are coming out of the White House right now, that I do think the administration is going to push American businesses and American universities even to try to open back up. Please do not go back to work. That's my only hope, is that, just if you're able to work from home, please work from home.
Yeah, definitely. If you can work from home, work from home. It's really rough on a lot of people. This is all going to be very rough on all of us. But I don't see myself going to a baseball game anytime soon.
No, or getting on a plane and going to it. And so, yeah,
No.
I agree. I do think probably the national lockdown or extended lockdowns will be more likely, but don't be surprised when we see that the administration pushing us to get back to work. And then number 2, we already kind of discussed this, but I think I know your answer. So we'll jump it up, actually. I was going to ask you long, short, 2 million weekly jobless claims come Thursday. How about we'll jump it up and make it a little bit more exciting? Long, short, 3 million weekly jobless claims come Thursday.
You know what? Let's do 2.5 because
Okay,
3 million is a little bit. I don't know if I can go 3 million above
the
3
perma bull in
million.
you is not allowing it.
It's not allowing it, but 2.5 is a very kind of a bookie line, really good point spread type of bet. So 2.5 million. I will go. I'm going to go long.
Okay. I'm going to go slightly under that. I'm going to go short, just not because that there's not actually 2.5 million people that have been let go of their jobs or will be let go of their jobs in the next couple of weeks, just simply because I think, Anthony and I spoke about this, that the difficulty some people are going to have actually applying for unemployment, that there is some red tape around it, and it's not exactly the easiest thing to get. So I think that some people will have difficulty and just kind of give up and just hope for that stimulus package.
So I was talking to Brian Strait, who's one of our managing editors, and he lives in Connecticut. And we were talking about the claims in Connecticut, New York last week, right? So national average, or the national 4-week average, jumped 33%. In Connecticut, it was 8 times. And they were having a lot of issues processing that. And then, so it went from 1,000 to 8,000. if this is really going to be over 3 times or 3.5 times what it was at the height of the Great Recession, I don't know how they actually process it. So I think the officials, it might not be more than 1 million.
Yeah,
and if it is, it's probably due to the fact that they just they don't have time or the manpower to process the claims.
Yeah, I mean, I think we're gonna be reminded of that original, the Genesis rollout of the Affordable Care Act, where we saw just millions of people flooding the healthcare.gov website and it shutting down and it not having the ability to process the traffic. I think we're gonna see something similar, something reminiscent of that with these jobless claims.
Yeah, this is.
I think we're just, the government's not gonna be able to handle all of them. So, but. That being said, over the course of the next few weeks, we will see that 2.5 million. I would bet my house on it. Unemployment rate is going to at least be in double digits.
Next week, one of our long shorts is going to have to be April's unemployment number, because that's going to be reported out next Friday. Not this Friday, but next Friday.
Right.
So basically, we're going to have to do a long short on that.
Yeah,
and
I feel like we're going to be talking a lot about unemployment, especially in the freight industry, for the next couple months.
Yeah.
We're already seeing layoffs. It's going to get ugly.
Yeah.
This is happening at the same time where the underlying, the fundamentals of the freight industry weren't great.
And, it hasn't been nearly as ugly as a lot of other sectors, right? Not as ugly as the airline sector, auto manufacturing, all the restaurants and bars and salons on every Market Street across
on every
country.
main street across the country. Yeah.
Across the country. So it's good that it is good that transportation isn't taking quite the brunt of it, at least not yet.
Yeah.
So.
Not yet. We'll continue to keep everybody updated on the situation. We'll be talking weekly, but
yeah, very
that's
good.
the end of episode 21. Good stuff.
Well, let's wrap it up.
All right
there. Well, very good. Thank you for joining us, and we'll be back next Tuesday here live at 2 p.m. Eastern Time. And have a great week.